So it looks like we have just hit 1 p.m. Eastern Standard Time here in Boston. So let's get started. I see folks are still coming in, but we have a great roster and a fantastic agenda and content lined up for you. So in the interest of time, we'll kick things off. Today's session, GHG Protocol, Corporate Standards and Guidance Updates. I am going to run through the agenda and a couple of housekeeping issues, and then we'll get into introductions. So that's where we'll begin. And then we'll talk about existing accounting approaches. We'll touch on impact-centric approach, navigating the WRI's survey process, and then we will get into Q&A. If you do have questions throughout the presentation, please submit them via the Q&A button that you should see on the menu on your Zoom screen. You have all been muted just in the interest of no interruptions throughout the presentation. So that's the way in which we'll get to your questions as we get to the end of the content. So I am going to let the three people who are presenting today introduce themselves. Faraz, we'll start with you.
Hi, thank you, Tara. So my name is Faraz Ahmed. I lead net zero electricity at Amazon, which is part of Amazon's overall goal to be net zero emissions by 2040.
And Adam.
Yeah, thanks, Tara. This is Adam. Good to see everyone here. Thanks for joining. I lead our sales and customer success teams at Resurety, and in particular focus on our emissions data sets that we started launching in 2021.
And I'm Henry Richardson, an analyst at WattTime, and we're focused on providing electricity choice or emissions choice to people around the world.
Great. It's fantastic to have the three of you. And Faraz is going to kick things off for us.
Yeah, so thank you all for taking the time. I think it's worthwhile just to provide some context on here on the issues that we're trying to solve. And the existing Scope 2 guidance has really provided an incentive for corporations to reduce their emissions through renewable electricity procurement. And as that's been implemented, it's been a great success. But it has allowed some issues to manifest themselves here that we think can be improved upon. The three issues here we're outlining is first of all is around being reflective of physical grid emissions. So this is where organizations can think that they've zeroed out their electricity emissions when actually they have not. I'll use an example under the current guidance where a business who consumes all of their electricity during the day can procure an equivalent volume of electricity at night from a wind project and then claim zero emissions on the market-based method. The second is around not incentivizing the highest impact. So under the current guidance, corporations have lesser incentive in emission reduction measures when they're most acutely needed. And I'll give an example here of an energy storage or a battery where it can be charged at low emissions time and discharged at a high emissions time. And the current guidance, that's not appropriately recognized. And third, it's not encouraging the markets which are in need. So essentially what happens is that there's incentive to procure clean electricity in locations where it's easiest or cheapest to transact, which often results in oversaturation in particular places and consequently a reduction in the avoided emissions and underinvestment in markets that most acutely need them. And it comes back to the location aspect of the physical grid emissions. So an example could be where a corporate has a choice between procuring between two locations, one being California and one in Wyoming, and they would essentially, using the volume of electricity, have the same emissions impact when we know intuitively that in Wyoming, there'd be a greater avoided emissions impact by having electricity generated in that location. So those are some of the issues that we're trying to improve upon. And I'm going to hand over to Adam to give an overview of the current methods as well as the proposals for Scope 2.
Thanks, Faraz. Yeah, so giving an overview of the current methods of GHG accounting, according to WRI's Scope 2 protocol, there are really two buckets to categorize that in. One is location-based. And so this is looking at, in the area of electricity consumption, using average emissions applied to your load. What is the net emissions as measured at that location? This often is recommending the highest quality data factors, but annual average emissions over wide geographic areas are often used. Another is market-based, and this takes into account green energy purchases. In the US, these are commonly called RECs. Internationally might go by different names. GOES, for example, in Europe, effectively matching the purchases of clean energy to the consumption of energy on a megawatt hour to megawatt hour basis, with any residual leftover being applied, calculate the emissions left over calculated as an average emissions rate applied to that residual leftover consumption. So that's the current framework. And as Faraz said, that leads to incentives that aren't really aligned with the impact or impacts that can be enabled through purchases really focused on decarbonization. So what we're proposing here is to shift towards a marginal emissions framework that is really focused on aligning incentives with impact. And so that breaks down into two components. One is measuring the induced emissions from energy consumption, and we'll get into the details on this. But that's basically the emissions associated with load at that point in time, at that location, and the avoided emissions from clean energy purchases, again, at that time and location of that clean energy being generated. We'll get into more details here, but this is a high-level overview of the proposal we're talking about today. Next slide, please. So in order to create a common framework for terminology here, I just want to define what marginal emissions is as a data set, because one of the shifts that we are proposing is moving from an average emissions rate to a marginal emissions rate. And so to familiarize everyone with that, this is an example of a supply curve in a power market. The system operator dispatches assets, dispatches generators in order of cheapest to most expensive. I think many folks on the line are likely energy people and so are familiar with this concept. And so basically what happens is the cheapest assets are dispatched until supply and demand are met in a given interval, let's say a given hour. In this particular example, the arrow denotes where load is. And so in this particular example, let's say a gas-fired unit, inefficient gas unit, at 950 tons of CO2 per megawatt hour is the marginal unit. What that means is that that unit is going to ramp up or down in order to meet changes in load in that hour. So that means that an incremental megawatt hour of consumption would cause 950 pounds, of CO2 to be emitted. Next slide, please. However, in a different hour, let's say 1 hour later, demand might be slightly higher. We have a new unit that's marginal. Here's it's an oil unit. And so in this case, the marginal emissions rate is going to actually be much higher than in the prior hour because we have a different marginal resource that would respond to that change in demand. So that's a pretty intuitive sense, I think, or explanation of why marginal emissions change hour to hour. They also change based upon location. So this is a map from WattTime showing balancing authorities in countries across the US and including some international locations as well, color-coded by the emissions intensity of that location. And you can see a wide range from darker red in parts of the US, but that might be more heavily emitting, to lighter green, where we have a higher penetration of renewables in different markets. And that's due to different supply stack composition by these different grids. There's also a wide range within particular grids. So not just between countries or between grids, but within a grid. So this is an example of ERCOT, and we see two projects. The triangles here reflect wind projects and the squares are solar projects, color-coded by the marginal emissions intensity at that particular location over the time window here. I think this is a 6-month average window that we're looking at. Two projects relatively near each other have wildly different impacts, in this case, more than 2x between one project and the next. And that's due to transmission limitations between these two locations. So that's all to say that time and location matter for marginal emissions, for the impacts that your activities have on the grid. And so that needs to be taken into account with this approach. This slide illustrates what is happening when you generate renewable energy. The left-hand side is a supply curve, much like the one that we looked at in earlier slides, showing what resources need to be dispatched in order to meet supply, where that arrow is. Sliding over to the right-hand side of the page, we see that the new renewables, those bright green boxed generators, are effectively pushing out the rest of the supply curve. And that pushes marginal resources off of the margin, and so fossil resources are no longer needed to generate. So the impact of that renewable generation is basically avoiding emissions that otherwise would have been produced. And that's a really important term, as I mentioned earlier. The avoided emissions of renewable energy is a big part of the recommended proposal that we're talking about today. So having grounded ourselves in common language and terminology on marginal emissions, this is the framework that we are proposing, which is measuring the induced emissions from load, which is in each hour to measure the load at that location and in that time, times the marginal emissions factor at that location, thereby measuring on an hourly location basis the induced emissions, and then separately measuring at each location of generation the avoided emissions from clean generation. So again, that's generation in each hour times the marginal emissions factor in that hour. Obviously, there's a negative sign here because generation is going into the grid while load is coming out of the grid. The total of those two will sum up to the total emissions impact of an organization on the grid. Over to Henry for moving this forward.
Absolutely. So we also wanted to show how this would appear in practice and how it might affect decision making differently than previous practice. So in this example here, we have an entity consuming electricity in California, a given quantity of megawatt hours, and they have the option to procure like a bundled PPA with RECs. And so you start to see they have two options, one in California and one in Illinois, and they're considering which procurement option to pursue. And under the kind of previous scope 2 market-based or existing scope 2 market-based approach, that calculation is really done on a megawatt hour basis. So they're going out and procuring the same number of megawatt hours in RECs, potentially through a PPA, as they are consuming, so that they are able to zero out that emissions footprint under the market-based approach. And you can see there's no difference in these different procurement options. They are treated equally under scope 2. So the solar project in California, even though we intuitively know it doesn't have the same effect as a wind project in Illinois. And so if you shift to this kind of induced and avoided framework, you can see by having load in California, you force emissions to occur, and that's your kind of induced emissions. But that solar generation, even though they're the same number of megawatt hours, doesn't have the same benefit and is only avoiding 2/3 of the emissions that you cause, because it's exacerbating curtailment, avoiding more efficient, forcing less efficient, more efficient gas generators off. Whereas conversely, that same number of megawatt hours in Illinois is forcing coal generators off the margin, having a significantly larger benefit for the same number of megawatt hours. And that subtlety is not captured on a megawatt hour basis of accounting. And so on the next slide, there's a kind of a detailed calculation of this where you can start to see that differentiation appear in greater detail. So the location base is just a straight across calculation of your footprint. There's no market measures permitted to reduce that footprint. Under the market-based approach, comparing different options shows how the emissions can change depending on the different procurement options and the shape of your load and the shape of that generation profile. And so one of the big questions on the next slide is really, how can you do this calculation? Are you able to do it today? And fortunately, there are some global data sets that allow this. So there's the UNFCCC data set, which is global annual marginal emissions factors for different interventions. There's also the eGrid non-baseload factors from the EPA, which is also, the UNFCCC data set is by country. The EPA non-baseload factors in the eGrid is actually by balancing authority. And then AVERT provides hourly marginal emissions factors for different ISOs and balancing aggregations. In addition to the NREL data set or the Cambium data set from NREL, which projects long-run marginal emissions rates into the future. And then Watch Time and Resurety are actually publicly releasing more temporally and spatially granular data for the US. But I think the important thing here is that this can be done today with existing data sets, as well as you can use the best available granularity and temporally and spatially data, so that you can do this calculation. So if you only have annual data in, let's say, Taiwan, that data set's still available, but there are more granular data sets in different regions that allow you to do this calculation. And then I really want to pass it over to Faraz to kind of speak to some of the things we're excited about in this new approach and how it kind of helps target investments in the most advantageous ways.
Yeah, thanks, Henry. So as Henry has described, right, this is now essentially creating an extra dimension of emissions. In addition to dollars and megawatt hours, we now actually have emissions impact as well. And this is actually, in my view, a simplifying framework, because it's very holistic in that you can combine and integrate both all load management and procurement decision-making decisions into this framework of emissions. And the result of that is that it should incentivize behavior that better aligns with this problem of maximizing the rate of grid decarbonization. How do you make sure that for every dollar or hour spent, that we're having the maximum decarbonization impact? It does that, for example, by incentivizing shifting load to cleaner times. So, for example, charging your electric vehicles at the right times. Incentivizing building of clean electricity generation in the dirtiest regions or the dirtiest hours to maximize avoided emissions. Incentivizing investment in load in grids that are going to have the least amount of created emissions as well. And it's technology agnostic because it's measuring emissions rather than particular sources. So it's applicable to all technologies as well: energy storage, geothermal, nuclear, whatever it may be. Yeah, another key thing I want to emphasize as well is that this is an inclusive framework. It's compatible with other implementation strategies, whether you want to procure locally or want to do 24/7 load hourly matching. But essentially what this framework is doing, it's actually measuring the emissions impact of those decisions. And those may or may not be equal to a net zero. And this is actually trying to give you a true reflection of those approaches. And finally, having some discussion around measuring the inventory or the footprint of an organization and the climate impact of the choices that they're making. And they, in some discussions, they've been treated as separate things, or separate areas. This framework here actually integrates it together, so you're able to assess the climate impact, but also you're able to tie back the reporting numbers to the overall physical amount of emissions going to the atmosphere. And the way you can do that is by if you total all of the scope 2 emissions from all of the organizations on the grid, both generators and consumers, that is going to equal the direct emissions from the power sector, the scope 1 there. So there's a direct and coherent link between the two. So bringing the voice here, well, right now there's a unique opportunity right now to actually, as practitioners, as a broad ecosystem, to actually put feedback into these, into the current process and how we'd like it to be evolving in the future for both scope 2, scope 3, and other areas as well. I'm really encouraging everyone to take the time to actually outline areas where that can be improved and outline suggestions for updates and improvements as well. The link here, yeah, here we go. The link here is shown. I am sure someone will post it in the chat as well, but do take the time to study this. I think it's going to be important to get as wide as perspective on this, given that this is such an influential set of protocols that affects such a wide variety of organizations.
All right, I think you're muted, so I will.
Thanks, Henry. Thank you, Faraz, Henry, and Adam. We're moving into our Q&A section of today's session. So just a reminder to submit your questions via the Q&A button that you should see in your Zoom menu. We do have quite a few that have come in already, which we were hoping for so that we could keep this an interactive session. So I'll get started. This first one, I think, is for you, Adam. Are you suggesting that the concept of a greenhouse gas inventory move from not accounting for the emissions you caused retrospectively to describing the emissions you avoided prospectively?
Yeah, thanks for the question. No, that's not the recommendation here, and apologies if that wasn't clear. There are a couple of different ways of looking at the impact of an intervention. One could be looking out into the future. I think that's being what's suggested here, the prospective approach. A tool for that sort of analysis might be like the Cambium tool that Henry mentioned, right, which is a long-run marginal emissions rate. Thinking about how is the system going to respond long-term over in reaction to this intervention. Instead, what we're recommending is retrospectively measuring with the actual marginal emissions rate in each hour at each location. What was that impact? So this is a retrospective approach.
Great, thank you. So the next one, if I understood correctly, every participant will multiply their load with the marginal emission factor to estimate their induced emission. But if all participants multiply their load with the marginal emission rate, wouldn't the induced emissions be much larger than the emissions that were generated by the whole grid? Alternatively, this would allow companies to claim companies more avoided emission than actually happened in reality, since everyone is using marginal emissions as their impact factor.
Absolutely. Nikki, do you think you could pull up, I think it's slide 23. This is an important, we have some appendix slides that are really important. I think this addresses a couple of the questions here. And one of the key innovations, this was put forward in a paper by Rudkovich and his co-authors about you have to apply this load calculation to everyone in the grid. It's in the appendix slides, I believe it's 23. And so the calculation says, okay, so all load entities must calculate their induced emissions, as well as all generation, including fossil generation. So we have that here. So a renewable generator, which has no direct emissions, calculates their avoided emissions. A fossil generator calculates their avoided emissions as well, less their direct emissions. So if you include this calculation, it actually sums to the scope 2 emissions sum to the scope 1 direct emissions. And that is due to this inclusion of the direct emissions. And so this is the formula for it, but on the next slide, there's actually a hyper simplified example of this where you can see there are 3 sets of generators. Oh, I actually missed I do apologize. I think I actually have this incorrect on the slide. There should be an extra column for energy, but you can see as you multiply these across, you get the avoided and direct emissions. For scope 1, you have your direct emissions. For scope 2, you have your indirect emissions, and you'll notice that the scope 2 emissions actually equal the scope 1 direct emissions if you include the generation in that calculation. We have a spreadsheet implementation of this. We'd be happy to share this with anyone. And so this is kind of a way to maintain the kind of accounting paradigm where scope 2 must be equal to scope 1. We're very excited to share that in more detail if you'd be interested.
Great, thank you, Henry. This one is for Faraz. Can you explain why this framework would be appealing to corporates or other organizations?
Yeah, I can take that. So I think there are a few of the aspects that I mentioned previously. So one is just around in a corporate, you want to have scalability. And the fact that this takes into account and are applicable to both load management as well as procurement means that it can be integrated into all sorts of decision making. Whether, for example, you're evaluating PPAs between different locations, you can actually then forecast the avoided emissions and understand the which is going to have the biggest emissions impact and incorporate that in your decision making. It could also be operational changes as well. So how do you optimize charging of an EV fleet, for example? It could also mean for investment decisions as well. So if you're choosing between where to site load, it could be a building, a data center, anything else. This is now you're able to calculate the emissions impact of that, forecast that out, and help to understand the emission implications of that as well. And I think also more broadly speaking as well is that, you know, we need something that's going to be future-proofed and flexible enough to incorporate innovation over time. And that means that if we include new technologies, new use cases, whether it's demand response or anything else, new technologies, all of that can be now quantified and measured through this lens of emissions, as well as the traditional metrics of dollars and megawatt hours.
Super, thank you. The next question is this a project/intervention-based method, meaning that a reporting organization would only be given credit for interventions that reduce emissions relative to a baseline?
I'll take this and then I'll hand over to Adam to comment further. So yeah, it is right that when you're calculating or showing avoided emissions, it is comparing it to the counterfactual, right? The chart that Adam showed there showed the example where essentially with new renewables being adding in, the supply stack changed, and there was fossil fuel generators pushed off. So it is comparing to what would have happened had that the clean electricity generation not have happened, and so. I think the grid operators have a really firm view of what's happening and what the marginal plant is, and therefore, under a sense of consensual assumptions, it should be perfectly applicable to then understand what is the impact of a particular intervention, like clean electricity generation or load management. Adam, do you want to comment further on that?
Yeah, I would agree with that summary for us, in that this is trying to match more closely the impact of an action with the way that action is reflected in your accounting ledger, let's say, right? So organizations are incented to follow the incentive that sort of the accounting structure lays out, right? So if you're trying to reach net zero, you're going to go about that in a way that is optimized for anything that you're considering, right? Costs, location, availability, and making sure that the incentives of that structure align with the actual decarbonization impacts those actions have is basically what we're advocating for here today. I do think it is worth mentioning that the impact of particularly large actions aren't going to exactly measure the marginal emissions rate times, say, that generation, because the marginal emissions rate is just looking at what's at the margin, right? And there can be pretty large impacts of a large intervention, such as a large wind farm. However, we have found through our analysis that is a very close approximation of that impact. We wrote a white paper about that, and DL, my colleague, analyzed the impact of large interventions versus smaller interventions. And so we found that this much more closely matches the impact of actions than using alternatives such as annual average emissions or hourly average emissions or megawatt hour matching. So that's sort of some of the rationale here. And I don't know if Henry, you want to add anything on to that point as well.
No. Okay. Thank you both. And Adam, you referenced a white paper. One of the questions that came in was asking if we could share the white papers from both Resurety and Wattime. And yes, we will definitely follow up after the session with a link to the recording, as well as links to assets, relevant assets. The next question, do you think that renewable energy investment should result in traditional tradable project offsets, e.g. tons of emissions reduced?
I think this ties into a larger question of additionality and RECs in general. And so I think what we're trying to do is shift this accounting closer to the emissions impact of different choices. And one key element in there might be additionality, and it would be additionality in how you would ensure that your intervention caused that renewable energy to be created, and thus the corresponding reduction in emissions. We're kind of exploring different ways of quantifying that. Faraz, did you have anything you wanted to add to the question of how this would relate to RECs and associated emissions reductions?
Yes, I did want to comment on RECs. So that's one of the most common questions is how this could be integrated. So, you know, and I'm just speaking for my own personal perspective here, is I don't think this is going to change anything regarding to RECs or eliminate RECs, but I think the natural evolution of RECs would be to incorporate this emissions-based framework into them. And so if you're getting more granular RECs, both in terms of time and location, if you can augment that data so that you're understanding what is the avoided emission impact for that unit of electricity generation, that then is actually sending the right signal. And it's also then going to allow different procurement decisions. So you could have a buyer who could buy a lot of RECs with a low marginal avoided emissions rate, or you could have an organization which is going to try to enable a project that has a relatively small amount of RECs, but with a high margin, a high avoided emissions rate. But that decision essentially is left up to the buyer, but the actual emissions impact is clearly quantifiable and transparent as well. And with that transparency, I think is a lot of the criticism is happening is that it's not clear the fact of what is the impact, and all the assumption is that all the units of clean electricity is the same when we know it's not. So I think with this theme of transparency can be integrated into REC and other markets so that buyers are getting the right signals, and then a natural market and evolution can take place.
And I think I would emphasize there that RECs would continue to play a role in ensuring there's no double counting and limiting claims and that type of thing.
Okay, here's one for Adam. It states, Adam presented a slide showing that new renewables, light green, would displace a gray bar. Why wouldn't it displace the red bar, oil?
Maybe we can pull up that slide, would be helpful to answer that specific question. So in this particular example, it might not be super clear, so apologies if that's the case, but the system load is intended to be represented by that black arrow, about 2/3 towards the right-hand side of each supply curve. So that's where load is. So oil is already not generating in either scenario, so it wouldn't be impacted. It would only be the marginal units that are impacted here. And that's why it's the gray planes.
Thank you for that clarification. In California, renewable portfolio standard compliance is done based on contracted energy and not actually dispatched energy. How could this approach be used to determine RPS compliance?
This is an area I don't have a lot of expertise in, but I kind of view an RPS as a different mechanism. It is a state mandated mechanism whereby the state says you must have this amount of renewable energy in your portfolio. And this is the mechanism by which you prove that. And so I think it's a slightly different approach than kind of corporate voluntary reporting, which is kind of the primary thrust of Scope 2 or the corporate standard writ large.
Okay, thank you, Henry.
Yeah,
Sarah,
maybe I'll add on to that if that's okay. I will say that some markets are evaluating, are there opportunities to better align the impacts of actions and the energy being procured with these sort of state incentive programs. So PJM has been working through the CAP-STIF, which is basically a evaluation of clean energy market structure. New England has released analysis on the New England Forward Clean Energy Market. In both cases, the emissions impact of specific projects has been considered as a way to measure the value of those projects. So that's one of many tools that I know states are considering in terms of driving clean energy policy going forward. I think there's a wide range of different tools that the states are considering and do exist, but that's one of them.
Okay, next one for Faraz. Would Amazon as a global company invest only in interventions in their dirtiest regions where it operates and then offset the emissions in their GHG reporting in regions that are cleaner? How do you deal with market boundaries?
Yeah, the market boundaries is an important one. And I also just want to take this opportunity to mention is that Amazon has co-founded a coalition called the Emissions First Partnership. The website is emissionsfirst.com, which is 10 corporates essentially putting out its position on how the Greenhouse Gas Protocol should be revised to maximize impact. So I do encourage everyone to take a look there. And on this concept of market boundaries, I do want to emphasize is that this emissions-based framework that is being discussed here can operate with or different sets of boundaries. So you could operate this and utilize this within a particular grid or within a particular country or across different countries as well on a global basis as well. As part of if you look at the principles outlined there on emissions first, essentially I want to reframe the problem here. The problem is not grid decarbonization. The problem is the rate of grid decarbonization. So we have to try to decarbonize the power sector as fast as possible to align to 1.5-degree climate change scenario. And so to do that, given the limited resources that corporations or organizations have, the question becomes of how do you do this in the fastest, most cost-efficient manner? And if we start moving towards emissions, there would be an argument to say that actually, we could actually loosen the market boundaries to have the highest impact. So, for example, an organization, if all things being equal, could have the choice between, say, doing a PPA in Australia versus France. Then we will know that from the data that PPA in Australia would have a higher emissions impact than doing it in France, for example. And so this would allow different procurement strategies to occur, and it's not for any standard to set how that could be done, but I do think there should be a true reflection of that, so that organizations who are spending time and resources in trying to enable procurement in more emission-intensive locations are given full recognition of the emissions avoidance that they're creating. I hope that answers the market boundaries, because I think it's an important point.
There was an interesting question about what about using the same approach, counting CO2 instead of megawatt hours, but using average emissions factors because of their simpler additive, et cetera, features. Adam, do you want to take a stab at this? I'd be happy to as well.
Why don't you go for it?
Okay, so I think one of the reasons we deliberately use marginal emissions is that it better aligns actions with the grid needs, because it's saying what would be the effect of your intervention, and that doesn't affect all the generators of the system. It primarily affects the marginal resources, and it'll better inform siting decisions. As Faraz was saying, it'll better inform load shifting to say, what is the effect of these choices? And that should be reflected in accounting, we think. Would either of you add anything to that?
I would just add, aspect of average. It's very easy to think of average, but I would also use the analogy in power markets, right? So for those of you who are familiar with power markets, we have location marginal prices, and it's essentially taking the same framework and now applying it to emissions. So we don't use average prices. We look at the marginal generator on a plant and the marginal price. This is a very similar construct now, but applying it to this third dimension of emissions.
Okay,
I see, Tara, there's a question here on if I have a lot of on-site solar on an otherwise dirty grid, how does my behavior get rewarded? I think that's a good question. So back to my point about how this is scalable in a unifying framework, think about it for an on-site solar on a building, because now we're measuring the emissions, the induced emissions from a building on a dirty grid. As you're now getting essentially an on-site generation, that's reducing the net load being consumed. So essentially how this would appear on your calculation is that your induced emissions would go down, because you're now essentially creating less net load, and that therefore has less induced emissions. So that is rewarded, but not so much on the procurement side, but on the net load side.
Okay, thank you. We do have quite a few more questions here and only about 7 or 8 minutes left. So I don't know if any of you panelists are seeing questions that you want to prioritize here. If so, you can jump in.
Maybe one that I can take, Tara, is one that I saw on battery storage or hydrogen production.
Okay.
Because this is an area where we spend quite a bit of time. So the short answer is that batteries, interestingly, act very similar to load in some periods when they are charging, and generation in other periods when they're discharging. And so the beauty of this approach, as Faraz mentioned, is that it's technology agnostic. It's just looking at what is the energy being consumed by the grid at that location in that hour and the impact of that. And then what is the impact of emissions being avoided when discharging into the grid. And so this fits perfectly with storage and hydrogen by extension, electrolyzers, for example. So we are currently working leading with Meta and Broadreach Power, a consortium that's now up to nearly 50 organizations that have joined, called the Energy Storage Solutions Consortium, which is trying to define a framework for earning carbon credits for storage to incentivize operation in a way that does exactly this sort of thing, right? Which is, instead of optimizing storage on revenue, trying to maximize price, instead focusing on maximizing emissions impact, which today are very different things. There's some interesting studies showing that storage can actually increase system emissions in certain locations if you're not taking emissions into account in your charging and discharging strategy. And so that's something we've been working on for about a year now. We're making good progress, and it fits perfectly with this sort of approach.
Tara, I do want to take one question here, and maybe we can then have some time to close because I know we're ending. But this question is, do you expect businesses to convert to this accounting method without a vision to the Greenhouse Gas Protocol accounting? I think the purpose of the Greenhouse Gas Protocol accounting is the reason we're having this webinar today. Back to the point, the last time there's this revision was 2015. It's now been almost a decade afterwards. At that point in time, the aim was to get corporate procurement engaged. There was less than a gigawatt of cumulative procurement taking place. We've now got over 100 gigawatts globally. So there's been an explosion in demand, and that objective has now been met. We're now essentially entering this, what I calling the next phase of ambition for grid decarbonization. And that's why this move towards emissions is an evolution to help us get to the right data and right metrics towards a net zero. So my urge to all of you is to take some time to look at the WRI website and familiarize yourself with the survey, given that this deadline is coming up on March 14th. Because I do think it's going to be important opportunity for everyone, not just corporate buyers, but also developers, financiers, grid operators, investments, anyone else who's really touching the space, to be able to explain the issues that they're facing and some of their suggestions, proposals of how we can collectively improve this. So I do want to mention that because the Greenhouse Gas Protocol really is central to how we think we can actually affect change. And I think there's a role also for auditors and others to give the confidence that these changes can take place. We do think that this is implementable and not just a theoretical conceptual construct.
Maybe one or two last questions. We see a lot of questions about where this impact-based approach stands, and I think we're kind of proposing that it stands next to the existing metrics, and how it interacts with them could be determined. And I think another recurring question that I think is important is, that I want to reiterate, is adding this calculation doesn't necessarily increase the complexity considerably. We're not advocating that this be required to be calculated on an hourly basis. It should be calculated with the best available data that you have. So if you're a small organization that only has annual or monthly data, you can match that with annual or monthly marginal emissions data. And the shift is like you're calculating your induced and avoided emissions on whatever granularity you are able to, based on your capabilities. Any other questions leap out at anyone?
Yeah, we did get through quite a few of the questions here. Thank you very much to our audience for participating in the session and for making it so interesting and interactive. On our last slide here, you'll see everybody's contact details. If we didn't get to your question today, expect a follow-up email from me. I'm Tara Bartley. If you respond to the confirmation email that you got, that will come to me directly as well if you have additional questions that we didn't get to today. And as I mentioned earlier, we will definitely be sharing a recording of this session with you. We'll also send you links to the surveys, as well as links to some of the white papers that Rashurti and Wattime have recently authored. So I want to thank our panelists for joining today, for leading a great session. And if you have any parting words, we're just about at time.
No, thanks all. I would encourage everyone to have a look at the Emissions First website if you have an opportunity.
I will share the link to
useful.
that as well.
Thanks.
Yeah, thank you everyone for attending.
Thank you very much. That concludes our session today. Thanks again for joining. Have a great rest of your day.